the market seems to be focusing on the stimulus and the odds that we will have at least another $1 trillion of stimulus. And so the market is running with that. And it's both cyclicals and growth stocks. So that's somewhat unusual. So the bull market is broadening out. So I can say I was wrong about what I believe the impact on the stock market was going to be, certainly in the short term, and I hope in the long term. What we did get right last year, and we believe this will remain true this year as well, is the V-shaped recovery. Now, we're probably going to go through some wobbles here because of the resurgence in the coronavirus, both the infection rate and the fatality rate. So I think that could put some fear, already is putting a lot of fear back into the system. And really causing turmoil in a lot of lives. So some stimulus to address that part of the population, we would agree, is absolutely necessary. Nonetheless, we think that the forces in motion, and which started last year, are still in motion, and that the equity markets are basically saying they will continue through this year. We think we're in a very strong recovery, on balance, with the occasional wobble as we negotiate the coronavirus. We think there could be an earnings explosion, and we're already seeing the surprises relative to expectations. They are some of the biggest surprises I've ever seen in my career relative to expectations. And last year, we believe the S&P 500 delivered $100 in earnings on average for the year. The year before, it was $140. Now, the fourth quarter estimates are coming up rapidly, and we will get those results. So we were probably north of $100. But now it is looking like, given the momentum exiting the year, that earnings in 2021 could approach $200. So that would be a doubling from a very low base last year. And that will be some momentum for the markets to continue and run with. We saw something else happened within the last week, and that was treasury yields breaking out above 1%. This is the 10-year treasury bond yield. And most bond observers and investors, I think, have been surprised at the power of the move through 1%. This seems to be breaking a long-term trend that many thought would not be broken for quite some time, especially because of the Fed's current monetary stance. The Fed has said it's going to stay, it would prefer to err on the side of ease at least through 2022. So with that in mind, the Treasury bond yield moving very rapidly through a key resistance point from the bond investor's point of view was quite surprising this early in the year. And that has many people thinking or wondering what are the reasons. And we'll get into that in a moment when I go into more detail. What it does do is help with or make people wonder, are equity values, have the valuations gone too far, and now long-term interest rates moving up, which tends to be a dampener on valuations, are we now going to see valuations retrace given what's going on in the bond market? One of the nice things that has happened is, as I mentioned earlier, the equity bull market is broadening out with cyclicals joining the party. And actually, we're very gratified to see that. I think this is potentially a virtuous cycle at work. First, with monetary policy, M2 is still up 26% on a year-over-year basis. We've never really seen numbers like this before. And so they're causing all kinds of questions. And of course, with the bond yield breaking out, and certainly 1% doesn't sound like a high number, but it is breaking a trend. The 26% growth in M2 is taking on new meaning, causing a lot of other questions. We do think this year, if we're right on both the magnitude of the cycle ahead and the fears associated with commodity prices rising and the dollar falling, we do believe that the Fed is going to have to reassess its plans. We do not believe they will be able to remain. They will be able to remain neutral or easy during the next year, given the power we expect behind some of these moves. Copper prices, for example, are up 75%, a little more than 75% from the low in March. Now, of course, that was quite the low, but nonetheless, they have moved up quickly. They are still moving up, and the dollar is moving down. Those are early indicators that we probably will see more inflation than most expect. We think it's more of the cyclical variety, supply getting back in line with demand, and that it will not become endemic. And in fact, as we've said many times in the past, we think the deflationary undercurrents associated with the 5 innovation platforms and 14 technologies that are evolving at the same time now, those deflationary undercurrents are going to become quite powerful as electric vehicles and collaborative robots start to proliferate. Now, they're not at a high enough base yet to move the needle dramatically, but we do think they will scale dramatically during the next few years and get to the base where that deflationary pull really will be felt by the markets. One of the other things we would say if the Fed does reassess is that would be good news on our part. I know a lot of people would become quite concerned because it is a change. Nobody likes change. But just as we said during 2017, when the Fed was pushing interest rates up, we thought that was a good thing. We thought, wow, the Fed is comfortable enough now with what's going on out there to let the market work and not try and impose itself on the economic system. And we think that psychology will win out this year, but we do expect there to be some shudders or fears out there as the Fed does begin to change its spots. On fiscal policy, we do expect another $1 trillion. We hope that it will be targeted and that what we saw in the last package with 5,000 pages and so forth does not repeat. But once we're through shoring up those who have been devastated by this coronavirus, we don't think the economy needs any more stimulus. With what's going on in asset prices, particularly stocks and real estate, we think there's a lot of powerful activity out there and positive signaling that the stimulus will lead to nothing but higher taxes and probably will be much more wasteful.